Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, as always, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. I will begin as I always do. Thank you for your service. You don't hear it enough. You'll always hear it here. And especially during these crazy and difficult and topsy-turvy times, we appreciate you more than ever. You are the glue holding everything together, and we are grateful for that. We're back once again with the incomparable Ed Zurndorfer, the guru. We are continuing remotely for Ed's safety, my safety, everybody's safety, but we are still coming to you as part of our mission to reach, teach, and serve you. At the outset, I always have to say this. I need to say the opinions of our guest, Ed Zurndorfer, no matter how amazing they are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information purposes only and not to be taken as advice. All listeners should consult their personal advisors before taking any action. As usual, these podcasts will mirror Ed's Fed Zone articles. I know you folks are reading them. We're finding they are searched a lot. You know, we see the Google Analytics on that, so thank you for doing that. You can find them at fed-zone.com. So if you are a first-timer, someone shared this podcast with you, that's where you will find the article. And what we do is we kind of hit the surface of it here, so it's a nice, easy listen when you're on the metro or at home, working out, that sort of thing. Pop the earbuds in, listen. We can take you through a lot of the highlights of this, and then you can go to the Fed Zone for Ed's article and really do a deep dive. So this one, we are still on open season. As I promised in the last one, Ed is going to decode and demystify health savings accounts, health reimbursement arrangements, and healthcare flexible spending accounts. And these are important because making the right pick for your situation can really add up to a lot of savings through the years, right, Ed?
Absolutely.
So let's follow your article and begin with your first article covers health savings accounts and health reimbursements arrangements. I'll hit the one high note on this. Both of them have to do with a high deductible health plan, and basically, I'll give it to you in layman's terms. That means there's going to be a big deductible with your health plan, but you're going to be able to save a bunch of money and put it away pre-tax. So you need that high deductible health plan. So let's get to what you call, and I love this, the trifecta tax benefits with HSAs.
In order to explain the trifecta tax benefits associated with a health savings account, I'd like to introduce it this way, Dan. I'm sure during your professional career, you have guided people to put money into what's called deductible traditional IRAs.
Yep.
And with a traditional deductible IRA, the contribution one makes, the contribution itself will result in tax savings. It is an adjustment to one's income. So, for example, if one's income is total gross income is $100,000, and they put, let's say, $6,000 into a deductible traditional IRA, their income is reduced down to $94,000. That's what they're going to be subject as far as federal and state taxes. This is before any other deductions like the standard deduction or itemized deductions. We're just looking at what's called the adjusted gross income. That contribution reduces one's gross income, resulting in less adjusted gross income. In turn, bottom line is the individual will pay less tax, federal and state tax, in the year of the contribution. Now, the money goes into the IRA, getting earnings, some type of earnings, whether it's interest, dividends, capital gains, inside the IRA, and nothing is going to be taxed until the money is withdrawn from the traditional IRA, which is usually well into retirement after age 59 and a half. The money has grown all these years, grown tax deferred, and no taxes are paid until the money is withdrawn. That is what's called a traditional deductible IRA.
Yep.
And then we have the other type of IRA, the Roth IRA, in which the contributions that are made to the Roth IRA are not deductible. There are no upfront instant tax savings by contributing to a Roth IRA. The money goes into the Roth IRA, also gets earnings. Now we get to the real lollipop with a Roth IRA. The earnings grow tax-free.
Yep.
Why? Because when money is withdrawn from a Roth IRA, it's called a qualified withdrawal. We're not going to get into the details about what qualified means, but generally it means you got to be over 59 and a half. It has to be at least 5 years since you made your first Roth IRA contribution. But the bottom line, Dan, is that everything coming out of a Roth IRA is federal and state tax-free.
Gotcha.
Now, the HSA, I call the HSA an IRA for medical expenses, with the following difference. You get the best of all worlds. The contributions that are made to an HSA are tax deductible. It results in current year, say in the year that you make the contributions of the HSA, results in current year tax savings. Mm-hmm. The contributions get earnings. You can invest it any way you like. There are ways to invest. You can invest the money through the HSA Custodian in various ways, and those earnings grow tax-free. Why? Because if the money is withdrawn, and you don't have to wait till age 59 and a half to take the money out of the HSA. When the money is withdrawn from an HSA and used for qualified medical, dental, vision expenses, when it's pulled out, you don't pay taxes. That's called the trifecta effect: tax-deductible contributions, tax-free growth, and tax-free withdrawals, all in one little package. And there's another thing that people should be aware of with the HSA. That's not true with a traditional deductible IRA. With a traditional deductible IRA, back in 1986, Congress changed the rules. And Congress said that if you're covered by a pension plan, and federal employees are covered by a pension plan, whether it's CSRS or FERS, or they put money into the TSP, and their income is too high, they're not allowed to make a deductible traditional IRA contribution. They have to make what's called a non-deductible. So there are rules, and the same thing is true with Roth IRAs. If your income is too high, you're not allowed to contribute to a Roth IRA. There is no income restrictions as far as who can put money into an HSA.
That's awesome.
You can't ask for more. It's all under one little package. But the only restriction is you have, in the year that you want to contribute to an HSA, you have to be covered by what's called you have to participate in a high deductible health insurance plan. What's high deductible? Every year, the IRS defines the minimum deductible. Next year for 2021, the minimum deductible for self-only coverage is $1,400. And if you have a self plus one or a self and family coverage for you and members of your family, minimum deductible is $2,800. I know everybody's being taken, ooh, that's a high deductible. Yeah, that is a high deductible. In summary, that's the benefit of, from a tax standpoint, the trifecta effect for having an HSA.
Gotcha. And in your article, you put a list of plans and links where people can find the high deductible health plans. So folks, pop over to the FedZone, fed-zone.com to do that. If there's a tax advantage, there have to be rules. And you already mentioned it has to be done for qualified medical expenses.
That's correct. If you pull the money out of your HSA, to pay for anything but qualified medical expenses, you'll pay federal and state tax, and if you're under age 65, you'll pay a 20% penalty. Ouch.
Yep. Good thing to avoid. You also mentioned that this can be used to help with kids up to age 26, which is a good thing. And then you touch on something, you mentioned it earlier, but I think it's worth going back over, about You had some guidance for selecting the custodian. Why don't you just talk a little bit more about that? Because that can make a big difference for somebody.
Yes. If one enrolls in a federal employee health insurance high deductible plan, as you mentioned, Dan, I put the reference there, which where individuals can, federal employees who want to sign up for a high deductible health insurance plan during the open season. There are three nationwide plans that offer high deductible that will qualify you to put money into and they associate with a health savings account. And the plans that do that they made arrangements with an HSA custodian. I'll give you one example. One of the most popular ones is something called HSA Bank. HSA Bank. They manage not only federal plans, but they do some people who work in private industry. They have access to high deductible health insurance plans. HSA Bank is a popular custodian. Now, HSA Bank, I'm not saying there's anything wrong with them, but being a bank, they're a little more conservative in terms of how they invest the HSA funds that are going in there. They tend to be a little more on the conservative side. They'll put money maybe in short-term bonds that don't grow over time. We have to realize that your HSA money is yours to keep. It's like an IRA. You want this thing to grow over time.
Sure.
Because one of the features of the HSA that people tend to forget is that it is yours to keep and use not only when you're an employee, but once you retire, you can pull money out of the HSA to pay for out-of-pocket medical, dental, vision expenses after you retire. It's identical to retirement account. You take the money out of a retirement account after you retired to pay for your living expenses. Well, you take the money out of the HSA after you retire. Any money left over that you didn't use when you're an employee to pay for medical, dental, and vision expenses after you retired. Also, I want to mention that talking about being retired, some of the things that you could, two items that come to my mind that you could use your HSA to pay to use withdrawals to pay for are long-term care insurance. Mm-hmm. You can pay your premiums with withdrawals from your HSA. Now, on the surface, this may not make sense to some people, but keep in mind that when you pay for long-term care insurance, the premiums you're paying are usually paid with after-tax dollars.
Gotcha.
After-tax dollars, not pre-tax dollars. But the rules for the HSA are that you can pull money out of your HSA pre-tax to pay for long-term care insurance premiums. In addition to, if you have long-term care expenses that are not covered, once you, let's say, go to a nursing home or you have home health care, things like that, and let's say you have some out-of-pocket expenses, you can pull money out of the HSA to pay for long-term care. Also, you can pull money out of your HSA to pay or reimburse you for your Medicare Part B premiums. This is something else, because most people who are enrolled in Medicare Part B, and I'm one of them, we have to pay our premiums. It's usually deducted from one's Social Security check. I'm not enrolled in Social Security yet, so I have to pay that Medicare Part B premium. It's an automatic debit from my checking account every month. So I could get reimbursed. If I had an HSA, I don't, but if I had an HSA, I could reimburse myself for that monthly premium for my HSA. This is simply amazing, what you can use this HSA to pay for in retirement.
And as a result of the CARES Act, it got even better, didn't it? Because it expanded to include some over-the-counter stuff.
Yes, it did. There's 5 new expenses. I don't have them listed. I may have it.
I can help you with that.
Okay, thank you.
We've got pain relief medications for headaches and muscle soreness, injury medications. As we record this, I'm hobbling around on a sprained knee because I'm an old guy who's stupid and tried out my kid's rhino rope jump rope. It's a weighted jump rope, and I landed wrong and tweaked my knee. And guess what? I'm taking Advil for that. And so cold and flu products, allergy products, so that would mean my Allegra, and heartburn medications. Literally, this thing just got way better, and it was already great.
Another great feature of the HSA, and I sort of alluded to this when I talked about keeping it for retirement. One of the complaints I get, and we're going to talk about this in a few moments, about the healthcare FSA is that you put the money every year into your healthcare FSA, and if you don't use it up, and from 1 year to that, yes, there is a carryover of a certain amount, but in general, if you don't use up the money in your healthcare FSA, it's a use or lose situation. That is not the case with the HSA. With the HSA, this is your money. You keep it. If you leave federal service, if you retire from federal service, any money in that HSA is yours. To be used later on. It's a very
deal.
It's a great deal, Dan. It's a great deal, and it's getting more and more popular. One of the reasons that employers now are offering HSAs, it cuts down the costs. The premium costs are cut down because of the high deductible. The cost of the insurance has been reduced, but many people get scared about that high deductible. I need to mention that under the Affordable Care Act, the HSAs have to have cover. I think I mentioned this earlier, that they must cover, must do preventive care without having one reaching their deductible. Preventive care means like things like well visits, or let's say colonoscopies, mammograms. That type of thing has to be covered if one has an HSA, has a high deductible health insurance plan. Those type of expenses are covered what's called first dollar. You don't have to reach your deductible. People should not get scared about the high deductible. And of course, there is a dollar limitation as far as how much one would have to pay out of pocket if they have an HSA each year. They impose dollar limitations on how much one would actually have to pay out of pocket, which includes meeting their deductible and any extra expenses before the plan, and at which time the plan will pay. That your high deductible plan will pay. So people should not get scared.
Gotcha. You sort of touched on this, so it's a great segue, where you were talking about the difference between the HSA and the healthcare flexible spending account. So let's start talking about some of those differences, because one of the things you brought up already is that you could put money into the healthcare flexible spending account, and if you don't use it all up, you might not be able to use it at all. So why don't you walk us through? There's some similarities to the HSA, but a lot of differences. So why don't you start walking us through that?
Well, let's just first start by saying that if one is contributing to an HSA, they cannot also contribute to a healthcare FSA. Those individuals, and then we also mentioned that with the HSA, you have to be covered by a high deductible health insurance plan. And there are about 3 nationwide plans under the Federal Employees Health Insurance that offer high deductible health insurance and associated with an HSA. Let's say an employee says, this is not for me. I'm really scared about that high deductible, and I'd like to join an HMO or a PPO, just a regular plan, a fee-for-service plan, where I have more control, I feel, about how I can control my medical expenses for myself and members of my family. So you join a non-high deductible health insurance plan. You're still going to have some out-of-pocket expenses. You're going to have deductibles. You're going to have co-payments. You're going to have co-insurance. And the best way to pay those out-of-pocket expenses for medical, dental, and vision is to enroll in a health care FSA. There are no restrictions as far as who can put money into a health care FSA. The contributions that are made to the health care FSA are pre-tax. It's deducted from one's gross salary. The money that goes into the HSA, into the health care FSA, does not grow, unlike the HSA. Withdrawals will not be taxed if they're used to pay for qualified medical, dental, or vision expenses. And again, you have to decide how much you want to put into your healthcare FSA every year. You have to join from 1 year to the next. If you do not use up all your healthcare FSA money by the time December 31st rolls around, you're allowed under under IRS rules to carry over, and this will be for 2021, if somebody has a healthcare FSA now, can carry over up to $550 of unused healthcare FSA funds. If the person retires, if an employee retires, they can no longer have a healthcare FSA. And any money left in the healthcare FSA when an employee retires is lost.
Ooh.
It's going to be lost. They have to incur the expenses that they're going to be reimbursed from their healthcare FSA before they retire. They have up to the day they retire to incur the expenses, and
Gotcha.
then they file a claim and they get reimbursed. So that's basically the difference.
In your article, you also talk about one other type of healthcare FSA, which is a limited expense or a Lex healthcare FSA. Why don't you touch on the circumstances where somebody might have that?
I got to be honest with you, Dan. I'm running out of alphabet soup here. I don't know if you got more alphabet soup for me. This is getting to be overwhelming here. And I think we have one more to go. I think we forgot about the HRA, the health reimbursement account.
That's true. That's true.
Okay, so we got one more to go. Anyhow, with the limited expense healthcare FSA, that's shortened to Lex healthcare FSA, what this is the following. If an individual, let's say, enrolls in a high deductible health insurance plan and has an HSA, they're eligible to contribute to the HSA. Mm-hmm. I mentioned a few moments ago that one cannot also have a healthcare FSA. The people who run the federal, it's called FedFlex program, FedFlex.
Mm-hmm.
They a couple of years ago designed a special type of healthcare FSA that will only pay for out-of-pocket dental and vision expenses.
Mm-hmm.
That's why it's called a limited expense healthcare FSA. And the rule is that one can contribute to an HSA and is able to enroll in a Lex healthcare FSA in the same year. But they got to remember that the limited expense healthcare FSA is only for dental and vision expenses for the enrollee and members of the enrollee's family.
Gotcha.
Only dental and vision. So they could use their HSA to pay for out-of-pocket medical expenses, and use the healthcare FSA, the Lex FSA, to pay for dental and vision expenses. They
Sure.
work together.
And you touched on it, so let's wrap up with it. Health reimbursement arrangements. That's for the person who can't get a health savings account, right?
An individual who is not eligible to contribute to an HSA, I want to just be clear here that if one has an HSA and they stay enrolled in a high deductible health insurance plan, they're able to contribute to it. But once they get out of the high deductible health insurance plan in a particular year, they keep their HSA, but they can't put any money into it.
Mm-hmm.
Now, who would not be an example of someone who cannot be in a high deductible health insurance plan? I should say, could not contribute to their HSA. Let's say an individual, an employee, federal employee, works past age 65. Mm-hmm. When you turn 65, you're eligible to enroll in Medicare.
Mm-hmm.
You're eligible to enroll in Medicare. If you are enrolled in Medicare, you're not allowed to contribute to your HSA.
Okay.
In fact, if you make the mistake of enrolling in Medicare at age 65, take an employee who intends to work past 65,
mm-hmm.
and many do.
Sure.
They enroll in Medicare Part A. Why? Because it's free. There is no monthly premium for the hospital insurance, Medicare Part A. And they were told, why not?
Got it.
But I have health insurance. Fine, your health insurance will be primary if you have to go to the hospital, and Medicare Part A will be secondary. No problem. Yep. The problem is that if you enroll in Medicare Part A, you can no longer contribute to your HSA. In fact, there's a big penalty.
Ooh.
you're going to pay a penalty to the IRS for having to contributing to the HSA. It's called an excess contributions when you were enrolled in Medicare Part A. I had a question from one of the those who serve reps, Dan, who said the person is turning age 65 next April and is very serious about enrolling in a high deductible health insurance plan because he wants to have an HSA. He never had one. He wants to enroll now during open season, and coverage will take effect on January 1st. Mm-hmm. And I said to the rep, Dan, you better tell that person not to enroll. And the rep said to me, well, his thinking is he'll enroll in a high deductible health insurance plan, and then he'll put money into the HSA, and then he'll shut it down once he enrolls in Medicare Part A. Can't do that because Medicare has a look-back rule of 6 months.
Yep.
And the person's going to pay a huge penalty. Now, what the person can do, and this brings us to the HRA, if you enroll in a high deductible health insurance plan and you tell the plan, I am not eligible to contribute to the HSA because, for example, I'm going to enroll in Medicare within the year, or I'm covered by some other insurance, like a spouse's insurance. My spouse has health insurance, and my spouse's health insurance is secondary to my insurance. So whatever I don't pay, my high deductible health insurance plan doesn't pay, my spouse's plan will cover the difference. Mm-hmm. You cannot contribute to an HSA then because you have other coverage. So what the plan will do is automatically put you into what's called a health reimbursement account, an HRA. Now, the HRA is not as good as the HSA in the following sense. Someone who enrolls in an HRA cannot contribute to the HRA. There are no upfront tax savings. And also, the HRA, what happens is the health insurance plan will put part of the premiums that are made to the plan into the HRA. These are called credits, and the credits do carry over from year to year. The credits can be withdrawn tax-free to pay for qualified medical, dental, and medical, dental, and vision expenses. Mm-hmm. The HRA is administered by the health plan, but once an employee leaves federal services or retires from federal services, the HRA is forfeited. That's it, no more. You can't use it in retirement. While someone is working for the government, the HRA can be useful, but they can't put any money into it. Okay. That's the bottom line. That's the bottom line. Dan, you got to be very careful about this. And this time of year, I'm getting lots of questions.
Sure.
About this, about the HR, about the HSAs and HRAs, and I'm answering the questions both from a health insurance standpoint. I put on my health insurance, my health license cap, so to speak, but then I got to put on my tax cap to talk about some of the tax consequences of this. It's very important that you consider all the ramifications of enrolling in an HSA, as well as the HRA. Also, the healthcare FSA has no such restrictions. No matter what plan you're enrolled in, if you are eligible to enroll in the federal employees' health insurance, just like we said, if you're eligible to enroll in the federal employees' health insurance, you're eligible to enroll in the federal employee dental vision insurance program. The same thing's true with the healthcare FSA. Even if you are enrolled in a different health insurance, TRICARE, or a private health insurance plan through a spouse, you still can put money into your into a healthcare FSA. There is no restriction. But the key is that you're eligible to enroll in the Federal Employees Health Insurance Program makes you eligible to contribute to your healthcare FSA.
That's important stuff, Ed. This is complex stuff. I've often thought, gosh, if there were a place that somebody, I don't know, from their computer might be able to log in and listen to an expert several times a year, teach about this stuff. Oh, wait, there is. Ed, you have webinars with us. So,
That's
folks,
correct. In fact, I want to make a plug for December 14th.
Please do.
December 14th. I'm looking at my calendar now. December 14th, Dan, we're having a federal employee health benefits, Medicare, and TRICARE webinar. And you know what December 14th is, Dan? The last day of the open season.
Yep. See, I'm good
at it. You still have time.
That's why I pass your quizzes. I don't do as well as Jennifer does, but I do pass your quizzes. And folks, if you tune in for Ed's webinars, you will also meet Jennifer. She is sort of Ed's protege, really, really sharp. Nobody knows as much as Ed, but Jen is working on it. No, it's true. It's true. Be sure to check in on those things, because if this open season you didn't get exactly what you want, it's not all lost. Unless this is your last year in federal service, and most of our listeners, that's not the case, you can learn throughout the year. You can be better positioned for the decisions that you need to make by coming to these free webinars. There's no cost, there's no obligations. Attend as many as you want, but please, please, please tell your friends, because this is a great resource and we are thrilled to be able to provide it. Go to stwserve.com. You'll see the red button right at the top. Hit it, you'll get registered. And believe me, Ed and Jennifer together is just dynamite, and you will enjoy it and you will learn a lot. Ed, I know I say this over and over again. I still don't know how you keep up with all this stuff, but I'm really glad and grateful that you do it on behalf of the feds, and I'm glad and grateful that you do it with us. Folks, that is a wrap. Ed will be back with us as we continue to work on our mission together to reach, teach, and serve you. We are serving those who serve. Be sure to subscribe to this podcast on our YouTube channel and on Spotify. Remember to share it with friends and strangers, enemies. Share it with everybody. Check us out on Twitter and LinkedIn. Don't forget those live webinars every week. 8 unique ones. We keep throwing special ones in there along the way too. The guru will come to you. We will reach you where you are, teach you where you are, serve you with where you are. Even in your bunny slippers, we don't mind. You can log in. Sign up for one, sign up for all, tell your friends. Be sure to read Ed every month in the Fed Zone. That's at fed-zone.com. So as always, for Ed Zurndorfer, Eddie Z, the crew at Serving Those Who Serve, and me, Dan Sipe, affectionately known as Danny Feds, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations. Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary.